Recently, I watched a really popular video about an option strategy that supposedly has a potential 300% weekly return. So, being a greedy person, of course, I found it very intriguing. According to this video, there are 4 steps to implement this strategy. Step 1 is to find a stock that the price doesn't really move. Step 2 is to sell 2 at-the-money call options with 1 week to expiration. Step 3 is to buy 1 in-the-money call option, also with 1 week to expiration. And the last step is to buy 1 out-of-the-money call option with also 1 week to expiration. In the example they provided, for step 1, they chose American Airlines. And how did they choose American Airlines? Well, they just applied their own logic and came up with it somehow. For step 2, at that point in time, American Airlines was around $19.40 something cents. So they sold 2 call options with a strike price of $19.50, which is the closest at the money strike. And for that, they collected a total premium of $60. In step 3, they bought 1 call option that was 1 strike in the money. So they bought the $19 call option, and for that they paid $56. And finally, in step 4, they bought 1 call option that was 1 strike out of the money. So that was the $20 strike, and for that they paid $16. So all in all, in order to put on this trade, they had a total net cash outlay of $12. And this does not include broker fees and commissions. For the purpose of this video, I'm not going to go into the specific mechanics of how the profit and loss is calculated. It's all summarized in this payoff diagram, which shows the possible profit or loss outcomes that happens based on where the stock price ends up on expiration date. Now, this trade has a maximum loss of $12, which is what was paid to put on the trade. And this maximum loss will be incurred if the underlying stock price, in this case American Airlines, is below $19 or above $20 on expiration date. The main idea behind this strategy is that the stock price has to stay within this really tight range within the next 1 week in order for this trade to be profitable. The maximum potential profit that you can make on this trade is $38. And this would happen if the stock price does not move at all by expiration date, which is 1 week from now. The 2 break-even points for this trade is at $19.12 and $19.88. Basically, if the stock price closes at one of these 2 points, the outcome of this trade will be 0. That means you don't make anything, you don't lose anything. Of course, that's not including your broker fee and commission. So what we see here is that there's a maximum possible loss of $12. So that's your risk. And there's a maximum potential gain of $38. That is potentially a 300% return in 1 week. And the stock price does not even have to move at all. Wow! Is this the secret to becoming a billionaire? Well, let's find out. So the first thing I'm going to do is I'm going to go to American Airlines on the Yahoo Finance page. And I'm going to download the weekly historical price data. Then I'm going to put all this data and plot it into a probability distribution table. I'm going to make a separate video later on to explain what are probability distribution tables and how to create and use them. The distribution table here shows us the potential outcomes if we had executed this trade on American Airlines stocks over the past 17 years. What do we see here? Well, the maximum potential gain, the 300% return, this only happens 4 times in the past 17 years. So basically, there's less than a 0.5% chance of us making the maximum gain. Whereas the scenarios in which we could have incurred the maximum loss, this happened 70% of the time. What this tells us is that every time we put on this trade, there's a 70% chance that we're going to incur the maximum loss of $12. And these 2 portions here between max loss and break even is when we can incur some losses. We notice that they happen 6% of the time. What this means is that all in all, there is a 76% chance that this trade is going to lose money. And with that, it means that there's only a 24% chance of making money on this trade. And this 24% includes that less than 0.5% chance of making the maximum gain. And let's not forget, we have not accounted for brokerage fees and commissions, which are a cost to you whether you make money or not. So that is likely going to push your loss percentage even higher. Well, I don't know about you, but after we consider the probabilities, the trade is suddenly not looking so great. What else can this probability distribution table tell us? We see that on average, this stock moves around 3% in either direction on a weekly basis. So if we still want to put on this trade, and we want to increase the chances of us making money, we have to widen the strike so that we increase the range of profitability. How wide do we have to increase it? Well, to the point whereby the break-even points are wider than a 3% move in either direction. If we go back to our original example and make some modifications. So now instead of the $19 strike price call option, we have to maybe buy the $18 one instead. And this would cost us $135. And instead of the $20 out of the money call option, we may have to buy $21 strike price instead. And this would cost us $5. So now in order to put on this trade, we have to incur a total cash outlay of $80. And that increases the maximum loss to $80. Does this still give us a 300% weekly return? Well, no, it doesn't. Suddenly the reward to risk ratio of this trade doesn't look so pretty. Alright, so let's go back to the probability distribution table and see if the enhancements we made to this trade would have increased our chances of making money. What we notice is that by increasing the margin of safety for this trade, we have improved our chances of making profit marginally to about 42%. That means we still have a 58% chance that this trade is going to lose money, and that includes a 27% chance of incurring the maximum loss of $80. So what's the lesson here? Well, there are plenty of option strategies out there that's pure rubbish, and it looks very, very enticing. 300% weekly return, like wow. But the reality is, there is no simple, quick fix, shortcut, easy hack to making guaranteed low risk returns. If anyone tells you that something is high return but low risk, you need to break down exactly what it is that they are trying to sell you. Because what we have seen is that in this case, it is potentially true that you could make a 300% weekly return. But this only happens less than 0.5% of the time. And 76% of the time, you're going to lose money on this trade. Out of which 70% of the time, you're going to lose all your money on this trade. Is this now a brilliant investment plan? I don't know. What do you think? Let me know in the comments below. That's it for today's video. Like, comment, subscribe if you found it to be helpful. I'll see you in the next one.